Hello, everyone, and welcome back to our channel, The Audible Review.
Mm.
Today we're unpacking, well, one of the great paradoxes of wealth creation, really. What if the key to the smartest investing strategy requires you to do absolutely nothing? We're doing a deep dive into the principles of coffee can investing, a philosophy that kind of elevates patience to an asset class itself.
Yeah, it sounds passive, doesn't it? But it actually demands incredible conviction. And for you, the listener who wants, thorough knowledge without all the jargon, our source material, mostly built around Saurabh Mukherjea and his colleagues' work, lays it all out. This strategy, fundamentally, it's about trusting time itself, not trying to time the market. And it really hinges on discipline in selection.
Okay, let's get into that concept then. This coffee can idea, it's got a bit of history, right? Robert Kirby in the U.S.
That's right, decades ago. The idea was literally putting stock certificates into, well, a coffee can and forgetting about them for maybe 10 years.
Simple enough. But our deep dive is more focused on how that got systematized and applied specifically to the Indian market.
Exactly. And that shift wasn't just about geography, it was analytical. The authors take that simple idea, buy high quality and hold, and they defined high quality with really strict quantitative filters. So it's not just picking a stock and crossing your fingers.
Right, okay. So what's the core of the strategy then? The bit that moves it from just a nice idea to something actionable. Principle one seems key. Invest in quality and forget it. But what does quality actually mean, according to the book?
This is where it gets specific. The sources are pretty insistent on two non-negotiables before a stock even gets considered for your coffee can. First, the company absolutely must show high integrity in its management. That's crucial. Second, quantitatively speaking, it needs to maintain a return on capital employed ROCE above 15%.
Okay.
And not just for a year or two, for at least 10 consecutive years. We're not chasing flashy growth stories here. We want steady, efficient performance.
That's a really important distinction. You're looking past just revenue growth to capital efficiency. And that brings us, I guess, naturally to the biggest enemy of this whole approach. Principle two, overtrading kills compounding.
It absolutely does. Most investors probably fail, not because their initial stock picks were terrible, but because they just couldn't sit still long enough. Think about the analogy they use in the source. If you planted a mango tree, you wouldn't dig it up every week to see if the roots are growing, would you?
Huh. No, probably not.
Well, every unnecessary trade is kind of like that. It's like plucking the fruit before it's ripe, It just cuts that compounding process short right when it starts working its magic.
But hang on, I have to push back on that just a little. If the plan is a 10-year hold, what if something genuinely bad happens to the company's fundamentals halfway through? Are we really supposed to just ignore major negative changes?
That's a fair question, and the answer really ties into Principle 3. Focus on management quality over market noise. The discipline here relies on the idea that if you did your homework right at the start, that rigorous filtering, the company should be able to weather short-term storms. The real measure isn't the share price next month or even next quarter. It's the integrity of the leadership, their long-term vision.
Okay, so stop obsessing over the daily blips on the screen.
Exactly.
And start focusing more on how the leadership acts, especially in a crisis. Do they look after minority shareholders? Do they stick to their game plan? Ethics over excitement, basically.
Precisely. And the long-term performance data shown in the source material backs this up. Portfolios built on high management integrity, plus those high ROCE numbers, they've consistently beaten many actively managed funds over the long haul in India. Which leads us neatly into the final point, really. Principle 4, simplicity works. The approach, it isn't glamorous, is it? Pick quality, invest consistently, wait. But the data shows it's powerful.
So thinking about this for you, listening right now, have you ever panicked? Sold a really solid investment just because the market dipped for a week or two. This deep dive is a good reminder, I think, that lasting wealth often comes from, well, consistent informed patience. It's more like brewing a good coffee. You can't rush it. It's a marathon.
Yeah, the whole mindset shifts, doesn't it? You move from chasing quick gains to strategically beating long-term peace of mind. Maybe, just maybe, the smartest move in investing sometimes is learning when not to move at all. Valuing your sleep over your screen time, perhaps.
Do like, share, and subscribe to our channel.